Good afternoon, good morning, and good evening for some of you. Thanks so much for tuning in. Welcome to Preqin's Private Equity in 2023 webinar. I'm delighted that so many of you have joined us today, and hello if you're watching the recording. My name's Grant Murgatroyd, and I'm Head of News at Preqin. In a moment, we will start the webinar with a presentation from my colleague, Angela Lai, who will take a deep dive into the results of our 2023 Preqin Global Report, Private Equity, which we published in December. Angela is a VP and lead private equity researcher in our Research Insights team. She's an asset valuation specialist with more than 15 years industry experience. We'll then move on to a fireside chat for 15 to 20 minutes. I'll be asking Angela the questions, and we'll also be asking you for your views too. Questions will pop up on your screen during the discussion. Click on the answer and we'll come to the results a few minutes later. We then have 10 to 15 minutes for questions from the audience. Some of you have already sent in questions and we thank you for that, but we want more. If you have a question, please use the Q&A icon at the bottom of your screen and not the chat icon. We'll get to as many of your questions as we can. We'll send all registrants and attendees an email next week containing a link to access the slides and the recording, plus information about Preqin's full suite of global alternatives reports and our premium Insights Plus service. And so now, Angela, over to you.
Thank you, Grant. Hi, everyone. I am Angela from the Research Insights team. And first of all, Happy New Year. I hope everyone has had a great break and are looking forward to what 2023 has in store for us. Last year, we crossed over to a very different macro environment, and private equity was not immune to many of the things that have affected public markets. So in the next 10 minutes, I'd like to quickly give you a sense of the impact on private equity activity. I'll be drawing also on our investor survey results for some insights on the near-term expectations. We will then look at the valuation and performance trends that are still playing out in the market. And finally, share a little bit on our longer-term outlook for private equity. So I always find it a little bit hard to talk about 2022 without first touching on a little bit on 2021, because it's just such a record year for private equity in so many ways. But if I have to pick one way, I always like to go with exits because that's what drives realized performance. And for investors, there is no better proof than getting your cash back. So as we can see here, chart on the left, 2021, Preqin data recorded $810 billion worth of private equity-backed exits. And that's a record high at a time when valuations were generally good because public markets were going strong. Now, this changed in 2022, and the data here, I'm showing just up to Q3, but that's $320 billion here. And in the first 9 months, that's less than half of the previous year's total. The average value per deal reduced as well, and that's because of one, valuations fell, and two, the number of private equity IPO exits have slumped to a low that we have not seen since 2008. And normally, with an active exit environment, more cash is distributed back to LPs. So if you look at here, the magenta bars represent capital distributed, and the dark blue represents capital called. The difference is net distribution, which is shown by this line in green. So in 2021, investors as a whole were finally receiving net capital distributions for the first time since 2017. Which means that investors would have the flexibility to reallocate. And that's not only positive for fundraising, but also with more liquidity in the market that drove deal flows as well as valuations in a very positive feedback loop. In 2022, however, high inflation began to take a toll on consumption as well as business profit margins. Central banks raised interest rates to slow growth as well as reduce liquidity in the market. This has put pressure on asset valuations as well as deal activity overall. And so even though distributions continue to be net positive in the first half of 2022, this time investors are not exactly rushing to put their money back to work. And this was our last survey in November, showing that investors consider the exit environment as the biggest challenge to private equity performance over the next 12 months. Asset valuations came second, but it has always been quite high on the list. Although the last time it was more driven by valuations being too high because competition for assets was quite intense. And this time it's because asset valuations are now falling. And of course, rising rates as well as stock market volatility, those are also on top of everyone's minds. And in the same survey, we asked about investors' expected capital commitments to private equity funds. So this chart here, if you pay attention to the bright blue at the bottom, that represents investors intending to allocate more capital to private equity in the next 12 months. And you'll notice that this proportion has really reversed for the first time in years, dipping below 40%. And of course, another consideration that might be holding investors back as well is the denominator effect, where because of the devaluation of the public portfolio, private equity allocations can look high or even go above the allocation limit. And according to Preqin's data, around a third of private equity investors were over-allocated towards the end of 2022. The slowdown in private equity fundraising in 2022 was significant. Private equity funds raised around 560 billion in total, and that's around 20% less than the year before. Regionally, Asia fundraising was the weakest, if you look at the bright blue close to the top of the columns, and that's driven by a steep drop in China-focused funds. To give you a bit of context, China-focused funds in 2022 raised less than 10% of the amount raised in 2021. North America was up year on year, that's the navy at the bottom, and that's driven by a stronger Q4, where 4 funds closed above 10 billion in just that quarter. And the largest funds closed was a Thoma Bravo fund that closed for $24 billion. Have a look, please, also at this purple line. It represents the number of funds closed. Now, notice how this has dropped more than the total funds raised. This means that the average fund size continued to increase, and we do see larger funds increasing their market share. The 10 largest funds in 2022 have made up nearly 30% of all funds raised. North America focused funds, as we saw just now, continue to take the most allocations, and that's because US remains the top choice for investors in the developed markets. But within emerging markets, we see quite a remarkable shift in appetite towards China, as can be seen in this chart here. Investors' interest is shifting towards Southeast Asia and India markets, although it's worth noting that these are relatively younger markets and they come from a much smaller base as compared to China in terms of private equity investments. Now let's have a look at valuations and performance for a bit. This is Preqin's buyout deals data, and we're showing here the trend of EV/EBITDA multiples in dark blue, and then we add S&P 500 for the same benchmark in magenta. Private equity transactions have always tracked public markets quite well, although sometimes wider or tighter, but the directionality is generally aligned. When valuations are low, that will affect exit levels as well, although some exits are just being delayed until more favorable market conditions return. And there will also be, of course, an impact on the mark-to-market of existing investments. So we could expect some reversal in private equity performance. But when we were looking at the performance data, as of mid-2022, that's June, the overall impact on private equity was only a low single digit, while the public markets were down 20-30%. And this could be due to a typical time lag because of the way private equity valuations are refreshed a bit less frequently. But when we break down deal level performance data into sectors here, we start to see some reversal being reflected in the IT sector, and that's the purple line on the very top, as well as the healthcare sector, and that's the dark blue towards the middle. So these are some of the most active sectors for private equity, and we could see the first signs of reversal as of the middle of the year. We should probably see more of that impact in subsequent quarters, given the way public markets have performed. I'll quickly touch on our industry outlook for private equity. So we've taken into account the recent changes in the macro environment, and we now expect AUM growth of private equity to slow to a CAGR of 10% over the next 10 years, reaching $7 trillion at the end of 2027. We expect that fundraising would be slower in both 2022 and 23, with a gradual pickup more realistically from 24 onwards. We see that as exits slow down, fund holding periods will be extended, and assets will stay under management for longer, supporting also this AUM expectation. And we expect lower valuations, higher borrowing costs, longer holding periods to negatively impact annual returns. For private equity overall, we forecast around 5 points down from the very exceptional 3 years, 2018 to 21, to around 13.5 on average annual return for the next 5 years through to 2027. So overall, some takeaways here. We expect private equity performance to moderate, with more reversal to be seen in the short term. That is driven by the macro headwinds, lower valuations, and slower exits. We expect fundraising to remain soft in the near term, and AUM would be growing at a lower rate than before. Because of the denominator effect, there is less flexibility for institutional investors, and funds will look to explore additional sources of funding from retail investors. At the same time, slower exits mean that liquidity will be a theme for both GPs and LPs, so we can expect more activity in secondaries transactions or continuation vehicles. Now, thank you very much for staying with me for all of 10 minutes. I'm going to stop here for now and hand over back to Grant.
Thank you very much for that, Angela. There's plenty for us to think and talk about in there. I was particularly pleased to see the comparison with 2021. I think that really helped show how far the market has changed in the past year. We're going to dive straight into the fireside chat now. So we've been hearing a lot of gloomy talk about private equity, and you've shown that there are some signs of slowdown in the data, particularly around fundraising and a little bit around the returns in IT and healthcare. But overall, the story looks more positive than for public markets. Is that true, or is this just the calm before the storm?
I think we are clearly in an adjustment period, and private equity as a whole would likely be seeing slower growth than the last few very exceptional years. And by slower, we're referring to fundraising, slower exits, lower performance, slower deals overall. And so if by calm before the storm, you mean by seeing some more negative performance in the near term, then yes, we expect that, because I think the impact of the downturn is not yet fully reflected into the unrealized performance. But I think that's already in the expectations of most investors, according to our survey, where the majority of them, including fund managers, are expecting negative performance in the next 12 months. So we do expect to see more correction to come in the near term, but I think investors would know that investments don't always go up in a straight line. There will be up periods and down periods. And if we think about the long term, I think even with our lowered performance expectation, which is 13.5% through to 2027, that's still quite decent if you compare to public equity indices like S&P or MSCI. Those 5-year returns would be less than 10% on average. So I think long-term investors would see the value of still having private equity in the portfolio, even if we have a few bumpier quarters, if you may.
Yeah. Okay, thanks, Angela. So storms overplaying it, more of an adjustment period. You're expecting to see a fall in the capital being returned to investors, and you mentioned quite a large proportion of investors being over-allocated. What does this mean for fundraising, and how much of a concern is that for GP's ability to make new investments in a market that, from a valuations perspective, maybe the most attractive it's been since the global financial crisis?
Yep. So we expect the net distribution to slow down, and that's with the data we just saw just now, capital returns to investors were still positive in the first half, but investors were just not rushing to make new allocations. So that's definitely slowing down fundraising, and we expect it to continue to be soft. But I think looking on the bright side, dry powder in absolute levels is at a record high in private equity. And that's because the period directly preceding this, namely 2021, fundraising was at a record high. So this dry powder could act as a cushion when fundraising is slow, and that gives fund managers the ability to react quickly as opportunities arise.
Okay, great, thank you. Sticking with the theme of a difficult exit market, how do you think this will impact the secondaries market? Where Preqin is currently tracking 127 secondaries and direct secondaries funds seeking to raise 108 billion, which is a lot of capital for a niche market. Will the next few years be special vintages for secondaries funds, given that we would expect to see increased supply of assets and more attractive prices, perhaps even deep discounts to NAV? And while Angela's getting ready to ask this question, I'd like to ask the audience the first of 3 poll questions, which has just popped up on your screen now. Which private equity strategy do you think is the most attractive at the moment? Click on the one you like the look of, and we will come to that answer after we've heard from Angela on secondaries.
So on secondaries, so with the exit environment remaining weak for now, secondary opportunities have definitely presented themselves more than before in the market, often at quite attractive pricing. Although what we hear of asset pricing is a very wide range of discounts, anywhere from 0 to 50%, which means that it really depends on the asset. But there are definitely benefits to both sides of the deal. So funds could offer liquidity to their LPs, and then from an investor's viewpoint, adding secondaries could help alleviate the J-curve effect in an existing portfolio. And also, Preqin data has shown some historical evidence of the outperformance of secondary strategies. So there are also some quite sizable secondaries funds in the market right now. The latest and largest one is a Blackstone fund with a target of 20 billion. That's just joining 2 other funds that are targeting 15 billion each. And we know one of them, Lexington, was expected to have made nearly a 13 billion close already. So we do see interest pick up. We see interest pick up from the fund search data as well. We definitely expect to see more activity in this secondary space.
Great, thank you, Angela. And going to our poll question answer, 39% of the audience put secondaries down as the...
Thank you.
Not that we were trying to lead people. Followed by 21% suggesting buyouts and 14% growth. Do you kind of agree on the buyout perspective as well, that they're still attractive? People talk about rising cost of debt, things like that.
Yes, so between buyout and growth, we are more positive on buyouts if you look at our long-term performance forecast. And that's because we think that the market's downturn is going to affect both strategies, but we expect the growth companies to be the ones with less secure cash flows, and they would be more susceptible to this downturn. That's driving our assumptions of that.
Okay, thanks, Angela. Coming back to new investments, do you expect to see a change in the types of deals that private equity investors are targeting? For example, IT is led in both fundraising and investment, but is seen by many as the sector most exposed to valuation corrections and market turbulence. Which sectors do you think will offer the best opportunities? And also, sort of related, do you see any changes in the characteristics of companies that will secure investment? For example, will we see a flight to quality in the form of market leaders and/or a greater emphasis on defensive characteristics? And while you're gathering your thoughts, another question for our audience on which sector they think will be most attractive for new investments. We'll come to the answer after we've heard from Angela.
Okay, from our data, we see information technology actually taking up an even larger share of deals in 2022. In the first 9 months of 2022, IT sector actually expanded its share of total PE deals to 30%. and that compares to around 25% in the year before. So this suggests that investors that have a positive view on this sector were able to take advantage of the valuation correction that you mentioned earlier, right? So we also look at the verticals within IT sector. So the most active industry verticals are cloud computing, mobile apps, AI. So those verticals, they're less likely to see people cut back on that just because the macro environment is weak. And there might even be actually arguments for more demand for them as a way for businesses to run more efficiently and even save costs for individuals. So that's why even as prices come down, these companies could offer some of the best opportunities in 23. That's my view. Now let's hear everyone's answers.
Thank you, Angela. And fortunately, you're on the same page as the audience as well.
Oh,
IT 31%, healthcare 30%.
right.
I think probably the interesting one there for me, raw materials and natural resources, which historically don't get much interest at 18%. Is that just tied to the high prices of commodities and energy at the moment?
Yeah, I think that is quite likely, and also with the energy agenda on renewable resources, that could definitely be driving that. But overall, I think the answers are quite in line with our expectations. I expected consumer discretionary to be probably one of the most avoided. At least that's what we're seeing in our deals data. Um, yeah.
Okay, great. Thank you. And moving on to the bottom line returns, you titled your slide Reversal in PE Performance Driven by Lower Valuation. So good that you're not sugarcoating the message there for our LPs. How do you think this will impact funds that are in the realization phase? If we look back at GFC, we see that the worst performing vintages were 2005 and 2006. Whilst their median net IRRs of 8.2% and 8.3% respectively were perhaps better than anyone had expected at the time that crisis unfolded, GPs did have to hold on to investments for much longer to achieve returns. Do you think we will see a repeat of that pattern?
We certainly think that investment horizons will lengthen, and that is in fact already factored into our performance forecasts. There's the consideration that, especially for these funds that are now in the realization phase, they might be exiting just later, delaying it until more favorable market conditions return, or else you would have to be exiting at lower valuations. Again, that's going to affect your performance.
Okay, thank you. So that's for your view of the picture for funds that are open and investing. How do you think that funds that are closing in 2023 will perform? Will there be a change in the composition of returns from private equity funds now? For example, less from financial engineering and multiple arbitrage and more for operational improvement. And not that I'm trying to put an answer in your mouth, but whilst you're answering, I'm going to go to the audience and ask whether they believe GPs have the skills to deliver returns through operational improvement.
Okay. Yeah, I think that 2023 will be an interesting vintage. 22, 23, investors may be slower to commit because of the macro uncertainties and the denominator effect. But it also means that as evaluations come down, there are deals that can be struck at better pricing than before. And that's especially for some sectors that could have been slightly overheated before just because it was too crowded. So IT, for example. Right? Whereas when you are transacting when multiples are at a peak, and then they're falling, you have to do a lot more in creating value internal to the business, perhaps just to even maintain at those multiples since your entry valuation was quite high already. So I would say that for 22, 23, your entry points could be lower. And also it's not a bad time to focus on internal value creation while the market is quite noisy, quite volatile. And of course, if markets go up later, that's always a bonus, and that will give you your multiples a boost more easily than investments from, say, 21.
Okay, great, thank you. We published a piece a couple of days ago using our asset level benchmarks that showed that revenue growth and I think multiple increases were the big drivers of returns across private equity portfolios, not leverage or EBITDA. So we're going to go to the answer from the audience, who do seem to believe, 73% of them think that private equity funds do have the skills for operational improvement. 27% think they don't. I did ask this a very similar question at a BBC event last year and got a reversed answer to that. What's your view, Angela?
I think we talked about this. It's a relief to get this result. I think it's definitely a vote of confidence. Maybe just speaking from a data perspective, in previous presentations, we showed this chart showing the median IRR of different vintages, from the earlier ones to the later ones. And the more recent vintages tend to to improve, which means that the industry as a whole have been improving with time. Although what's interesting also is that while the median improves, the difference between the top and the bottom performance also widened quite considerably. So that kind of highlights the fact that with more players in the market, you also have more dispersion in that performance. And so I guess selecting the right GP and the right strategy for you will be more important than before.
Okay, thank you. And I know that our colleague Sam has done a lot of work on this very interesting series on persistency of return. Thank you, Angela. That was great. You have a minute or two to catch some breaths and get a glass of water. And we're going to move to the questions from the real experts, our audience. If I can just give you all a few reminders. Thank you for the questions sent in already. We had some when we were sending out our invites. We've had quite a few in already today, but we're still open for some more, so submit them via the Q&A button. Slides and recording will be available to everyone. We'll be emailing you a link to all registrants next week. Please do feel free to share it with any colleagues or contacts who may be interested. Today's webinar is based on the 2023 Preqin Global Report, Private Equity, that was launched in December. If you'd like to find out more about how to access the report, a link is being posted in the chat now. This is the second of our alternative asset class webinars. We had hedge funds yesterday and we have real estate at the same time tomorrow. Next week, we have infrastructure, private debt, and venture capital. You can register using the link, which should be now in the chat box, and please do forward the invite to any colleagues who may be interested. And now, if you're ready, Angela, over to some questions from the audience. My first one is from Hubert Ule, apologies if I got the name wrong, from Raymond James. How can you be sure of the accuracy of the valuation of private assets? How do you discern a PE investor fund manager who is conservative about their valuations from one who may inflate asset prices to collect fees? He is fortunately not looking for an easy answer.
Okay, thank you. I don't have an easy answer, so that you're not looking for one. Well, generally, I think, let's say the short answer is you should try to understand how valuation works, and especially for your assets. And the long answer is that I think generally when we enter into an investment, that is when you transact, that value is always fair market value, because that's when money changed hands between two unrelated parties. And so neither one should agree to it unless it's a fair market price. So at inception, your valuation is always fair, and you could use that to try and reverse out the implied assumptions. So the implied assumptions would be, for example, this price implies this kind of revenue, this kind of growth, this kind of profit margin, and maybe as a benchmark, it might imply you have paid X times EBITDA multiple for this EBITDA assumption, right? I think it's really good to try and understand from the fund manager what are the main drivers or ideas behind those assumptions at inception, because they're always going to be there are going to be a lot of moving parts going into these assumptions, but the GP is best placed to assess and sort of apply that discretion. You know, what should be a fair assumption, and then after you understand that, as the investment goes, you could start to monitor how the GP remarks those assumptions. So because every time you revalue an asset, GPs might raise or lower those assumptions, and it's important to try and understand what's driving those changes. So, for example, are we missing some projections? But bear in mind that sometimes missing projections, 1 or 2 periods, that might not be a big deal. It's important it's more important to listen to what the GP is saying and what's being done about it, right? On the other hand, sometimes it could be purely market driven, right? So a little bit of advertising here. We are launching a valuation series in April, and that would provide you with more data on asset marks trends, and we try to give you some more granularity on sectors and markets. And this kind of market data is really good to have because as an external reference, you could see, okay, valuations are dropping in your sector. Why is that not being reflected in your asset valuation? So, for example, you can start asking questions, right? Is it because our asset is so unique that it's not comparable to this market sector, to this market data? Or is it because the fundamentals have improved enough to compensate for the lower price multiples, or the higher discount rate, for example? So yeah, I think I've really gone off on a tangent, but private equity valuations are definitely going to be subjective. That's because there's no price discovery opportunity. So you have to make assumptions, and that is the GP's expertise. And I think that in a long-term LP-GP relationship, both sides should be comfortable having this kind of dialogue. And of course, the ultimate test is, at exits, you would realize a loss if you are marked too aggressively. So yeah, so there was no easy answer, but I gave you a very long answer, as Grant will tell me. But valuation is one of my favorite topics, so thank you very much for this question.
So I think on that note, if you've got any valuation questions, please do feel free to direct them straight to Angela. Her email, angela.by@preqin.com. That was actually an excellent answer, Angela, and thank you very much. And I think no one size fits all, and have an open dialogue. And we saw that when COVID hit in the early months, and the quality and quantity of dialogue between GPs and LPs did dramatically change. Going to move on to another question. This one's from William Ulbors at Salesforce. Relates to one of the ones we asked. Do you see significant shifts in value creation strategies as a result of the macroeconomic downturn? And if you're an operating partner working with portfolio companies, which risks would be top of mind for you?
Okay, I think that value creation will become more important because the macro environment has weakened, and it also means that you cannot rely as much on price multiples going up or even staying where they are. So creating value is definitely going to be core, but creating value in a sustainable manner is also really important. So for example, Grant, you also mentioned before, financial engineering, but I mean, leverage is always going to be necessary. It's just that I think some of the risks that you should look at now is over expansion or high cash burn. Those would be really worth keeping an eye on, because if the environment really worsens, then do you have the flexibility to scale back, and just make sure you're not so tight that you run refinancing risks, right? So as we said, we do expect exit timeframes to lengthen in this environment. So making sure that you're sustainable and you can stay in the game for longer in the long run, that will be most important in my view.
Okay, great. Thank you, Angela. We had a few questions in about impact strategies, but I'm going to go with one from Simon Males of Tickley Howe Capital. Please, can you comment on the relative appetite and demand for impact strategies, particularly around climate and decarbonisation and issues like that?
We do definitely see the demand for these strategies, for these kind of businesses. If I think about clean tech deals, I think those have kept at similar level in 2022 compared to 21, which actually is quite good in an environment when all the other deals are falling, right? And you can look at other related industries, under this agenda, electric vehicles as well. That's definitely gone up. But I would probably say that a lot of this activity is going to be in the venture capital space rather than in private equity. And that's because there are just a lot of these early stage investments. So things that are more in R&D stage, such as carbon capture technologies or carbon neutral or carbon negative building materials and all of that, they are more on the VC side. I think we actually did, oh, actually Grant's team, has a lot of interesting write-ups on this space. We also have published before on clean tech, that's cross asset class. But if I remember, most of it would be probably in infrastructure more, and then followed by venture capital, and then finally private equity. That's sort of the situation now.
Yeah. And what do you think is driving the interest? Is it an ESG box ticking exercise or...
No, I think we all live on this planet. We all are incentivized, and these technologies, they are definitely good for the environment, but they could also potentially be quite profitable. I mean, and there's nothing wrong about wanting to be profitable.
Good, thank you. That's a fair answer. And now a question about secondaries. I think looking at trends within the market from Nathan Ritzko at Harbourvest. Can you provide some insight on trends into GP-led secondaries, including single asset deals?
Okay, I think we probably have addressed a lot of that secondaries question before. As we said, we do hear secondaries activities going up. We see that as a trend. We see interest coming from investors. We see the funds already out there. So definitely, we think that's going to be an area of interest in the coming year.
Okay. I know you just said that you dealt with secondaries, but I've got another question that's just come in on that. Is secondaries outperformance following a market downturn or over all periods?
Yeah, in our data, actually, most periods have shown an outperformance just slightly on the secondaries, but probably more so in the more downturn periods, like you said.
Yeah. Okay, thank you. Oh, someone's getting to the nub of the issue here. A question just coming via the Q&A. With expected returns decreasing, do you think investors will be less willing to pay management and performance fees? Will we see an increase in the use of stealthy arrangement fees?
That is a super interesting and tricky question at the same time, because I think fees is a supply and demand issue. It really depends on the dynamics in the market. We published the Fund Terms Advisor, I think just a few months back, and from what we see although there was a lot of supply of funds, there was also a lot of demand for funds, and so as a result, we didn't really see fees come down a lot. And the thing is, it's not really a top concern by investors at that point in time. I think because there was just so much demand to find a fund and get that allocation that people, that's just not the top priority, negotiating fees. But then going forward, will that change? I think that's also really interesting. Like I said, in the earlier part of the presentation, actually, there is a little bit of the larger funds kind of getting bigger, right? They're also gaining market share. So, would that really tip the fees discussion towards the LPs? Probably not for the bigger funds, but maybe because it becomes so competitive now for the slightly smaller ones, then those might see a change, just in order to get an allocation. So I think that could be something to watch in the coming year.
Yeah, I think it's interesting. Our sister company Colmore has some very granular data on this, and actually the movement on fees is not much. And our Fund Terms Advisor shows that it's probably a surprisingly not a particularly important issue for LPs. The masking of fees and hiding fees that should be part of transaction fees that should be part of a management fee, that does seem to be something that investors are less happy about. Okay, I'm going to go nice simple question here that's come in from the audience. Do you think the average fundraising period time would increase significantly?
Okay, I can definitely take this. Just want to thank the audience for asking this question, Grant. You usually announce the name of the...
Yeah.
Okay, so I think the average fundraising time and period definitely is increasing. I think we have statistics on that. Funds used to take less than 6 months to close. That proportion definitely has come down a lot since last year. But that trend has actually been coming down already even before this, and it probably will diverge. So again, it's the funds that are really large. We see them come in very quickly. They raise very quickly. They over target, and then they're done. But then it's the ones at the sort of like but just a bit below that bracket, then we see them really spending more time, and we see them probably, despite spending more time, they might not eventually meet the initial target either. So definitely we see a very competitive landscape on the fundraising side.
Okay, great, Angela. And I'm going to take you to a final question, which is again from the audience. I'm afraid I don't have names for them. This is quite a general one, but regarding the trends you have talked about, which sectors or geographies do you think will be the most impacted?
Okay, so as we saw just now in the fundraising data, APAC was really heavily impacted, and that is really because of China-focused funds. And that probably will continue for some time. That's based on our investor surveys as well. So it's actually not even just private equity. So across asset classes within emerging markets, China used to be the consensus top choice, but in this year it has, slipped to maybe third or fourth place. And, investors are just really not really being cautious in putting more money into this market until they could see more certainty. So I think, the headlines right now are still quite uncertain. I mean, it has just reopened. That's definitely the first step. But it still looks like it needs some time to settle down. And then the headlines on, let's say, the property sector, or on the geopolitical tension side of things, not a lot of positive news flow there either. So I think we're really going to, China is going to be a key variable, I think, for all Asia investors, because China has just been so much in the center of action for private capital in the last few years in Asia. So I think if you have been investing in Asia, there's a very high chance you're going to have some direct or indirect exposure to China. So I think, a lot of people have vested interest in this market, but I think we really need to see whether the situation will stabilize over the next few quarters.
Okay, great, thank you. And I'm afraid that's all we've got time for today. On behalf of Preqin, I'd like to thank everyone who joined us today for their active participation. I'd like to thank Angela for an excellent and insightful presentation and discussion around the key findings of the 2023 Global Alternatives Report Private Equity. Our global reports, as well as today's webinar, rely on Preqin Pro data. The platform provides access to the industry's most comprehensive private capital and hedge fund data sets and analytical tools. If you would like to learn more, please visit preqin.com. You can also request a free Preqin Pro demo by leaving your details in the feedback form that you will receive in your inbox next week, which will also include the links to download the slides and the webinar recording. Can't wait until next week. A feedback form will open in a new window when the webinar ends. We'd really appreciate it if you could take a couple of minutes to fill out one of the feedback forms. We do look very closely at feedback, and it helps us continually improve our webinars to bring you the best experience possible. Thank you all for attending or watching. I hope the remainder of your day is productive and enjoyable.